Most investors think managed funds give better returns because they're run by professionals. Well, I spent 2 decades inside the fund management industry, and I can tell you the reality is very different. In this video, I'll show you exactly how that's the case. You see, most people would never be aware of the tricks used by these companies that make them look better. Hi, I'm Manish Kataria. I spent years managing money at investment companies like JP Morgan. And during that time, I learned something really uncomfortable. You see, most managed funds consistently underperform. Yet the industry has some very clever ways to make that underperformance look acceptable, even attractive. So in this video, I'm going to walk you through the real numbers, the insider tactics, and what this means for your financial future. So let's dive right in. Now, a passive fund or an index tracking fund just seeks to match what the index is doing. It's just matching it, okay? Nothing else, just matching it. And that's a good thing because all of these indices historically have generated very good returns. Historically, on average, 8 to 12% per annum, going back, for decades, centuries. So it's a very, it's a proven, historically capable compounding machine, inflation beating machine. So that's a good thing to match it. But actually, active funds, they try to beat the index because they try to do something different and they have to justify their existence and their high fees, right? So they're always looking to beat the index. The problem with that is, more often than not, they end up underperforming. They end up underperforming the index and doing worse than what a tracker fund would do, okay? That's the problem. And I'm going to show in this episode, we're going to show some data and some information to prove how much of a problem that is by how much they tend to consistently underperform, okay? So that's the difference.
How do we know if something is an active fund? It's all in the fact sheet. Every fund out there has a fact sheet. You can obtain the fact sheet for any fund you're looking at from the website of your fund provider or from your pension plan, or ask your IFA if they're holding this fund. So your fact sheet is your friend. It contains a lot of information. It's often 1 or 2 pages long. It's often a PDF.
Now, how do they do it? How do they seek to beat the index? If you think about the FTSE 100 index, 100 names, okay? And the top 10 names, typically AstraZeneca, Shell, HSBC, Unilever, BP, etc., all the names that you would recognize. It changes from time to time, okay? And their weights change as well. They're not evenly weighted. So the top 100 stocks have their own weightings. AstraZeneca is the biggest at the moment at 9%. Shell, HSBC, Unilever, BP, they all have significant weightings, okay? So these are the market-determined weightings. An index fund essentially is run by computers because there's no real skill involved, right? It's just a replication process. The index fund or the ETF looks to see what the top 100 stocks are, looks to see what the weightings are, and it just replicates it in an index. Okay, so it's essentially the day-to-day running of an index fund is done by computers, by supercomputers. Okay, and Vanguard, iShares, Legal & General, they're all big providers of index funds. So this is what they do. Now, an active fund, on the other hand, they use human beings, right? And so they typically have very expensive fund managers sitting in very swanky offices to manage these funds on a day-by-day basis, okay? And how do they do it? They look to see what the index fund looks like. That's their starting point. They see what the top 100 is, and they look at the weights, and they deviate from those weights, okay? So AstraZeneca is the biggest name in the index at the moment. A fund manager may look at that and say, actually, I'm not sure if I want 9.1% of the fund in AstraZeneca because I don't fundamentally like AstraZeneca. So they might have a lower weighting, okay? And they might decide, actually, Shell has an 8.6% weighting. I don't like Shell at all. I don't like the oil sector. So I'm going to have a 0 weighting in this. So an active fund manager will deviate from the actual weights and the actual names, okay? And so you get the picture. And typically, the FTSE 100 contains 100 stocks. That's what the index fund has to replicate. An active fund may decide to only have 50 or 60 stocks. So that's how they earn a living. The active fund managers make active decisions
on what to include and by how much to include it. On a day-by-day basis, they're analyzing these companies, they're evaluating these companies to see which ones they like and which ones they don't like. And that's essentially how an active fund is run. And it's not just them, they have teams of analysts sitting with them, they have teams of external analysts with other banks who advise them on how to run these funds and what the analysts think of individual stocks. And they collectively take this information from all of these sources and they come to a decision. Okay, so that's how an active fund is run on a day-to-day basis. Now, there are different types of active funds. Okay, the one I've just described is typical. But there are also some types of index funds which are essentially cheating. Okay, so they're called index huggers, and they're not very well liked by the investment industry. Why are they called index huggers? Because they claim to be active, but they make very small changes. So instead of AstraZeneca being at 9.1%, they might decide actively to have AstraZeneca at 9.0%, okay, and so on. So they're making very small changes to the index weightings, but essentially replicating an index. So they call themselves active funds because they can then charge a premium fee, but they're not doing that much different. Essentially, in a nutshell, they're looking to do something different to a passive index, and they charge higher fees for doing that. Now, all of these active funds have very strong marketing machines, and you've probably seen all the messages at train stations, on the side of the road, on the TV, in newspapers, magazines, on social media. And the marketing appeals to all of us, right? Because they know the buttons to press, right? So you see all sorts of messages: the profit hunter, focused on performance, and unrivaled teamwork. And they might even have some data to back up their claims. So they are a very well organized, slick marketing operation. And they have to be, right? Because these fund management companies are very lucrative. They make lots of money, they make lots of profits, and the marketing is, if anything, even more important than the investment function. When I used to be a full-time fund manager, we had to do what the marketing guys told us, right? This was the most important function in the whole bank. The marketing ruled because that was what brought in the money. That's what brought in the pounds and the dollars. But the marketing doesn't just appeal to all of us as retail investors. It appeals to IFAs. It appeals to pension funds, people who are managing money on our behalf. And this is why I mentioned earlier, you may or may not realize, but actually these active funds might be indirectly managing your money through your pension funds, through your IFA managed funds, etc. So have a look out for that. Now, one of the marketing tricks that the active fund managers use is something called fund farming. There are lots of tricks out there, but I'm showing you one of these tricks. Now, fund farming is a bit of a dirty trick, okay? And it's essentially a laboratory of growing funds. So if you were to go online, say you liked a particular active fund manager, you liked their funds, they had a good brand name, you look to see what kind of funds they offer. You might only see 10 or 15 or 20 of their funds. Actually, behind closed doors, these companies are growing, farming, maybe 100 or hundreds of different funds. And the point of doing that is very clever. So what they do is they grow all of these funds, and they know that there is a decent possibility that 10 or 20 of those 100 funds will do really well, by luck, if nothing else. Okay, so they grow these funds, and the ones that happen to do really well amongst the 100, let's say there's a 10% hit rate, the 10% that do well, they market the hell out of these funds. They show the track record, they show how well it's done, and they're very selective. They only show the ones that are doing well. And so when we see the marketing messages and the numbers and the track records, we have to be very careful, be conscious that they're showing you what they're showing you, but they're not showing you what they're not showing you. Okay, and that's sometimes a result of fund farming. So be very careful. Track records are there, but it doesn't tell us the whole picture. And sometimes what happens is that the track record pulls in the pounds, pulls in the assets under management. And typically these funds which have done well during the selected time periods, then they start tailing off, then they start underperforming. But it's too late then, because these companies have captured all of this money, and the fund management companies make money regardless of the performance. Whether the performance is good or bad, they're going to take their percentage in fees anyway. Okay, so they're a winner whatever happens. So be very careful. And we talk about fees, let's talk about hidden fees, and let's talk about the extent of all the fees. So just a recap on fees. Passive funds or index tracking funds, they typically charge, call it 0.25%. Okay, that's their fee. Of whatever you invest, they charge 0.25% as the management fee. An active fund typically charges multiples of this. So anywhere between 0.5% to 2%, sometimes a lot higher. Okay, that's the headline fee. Okay, and those headline fees have to be high because they have expensive fund managers to pay. They have swanky offices to pay rent for. Okay, so they have a high cost base. And some of these companies are listed on the stock exchange, so they have shareholders to satisfy. Okay, in fact, investors are bottom of the pile. As I learned working in the industry, the number one priority is shareholders. Number two priority is themselves because they have bonuses to pay to their staff. And number three, as almost like an afterthought, is the welfare of the investors like you and I. Okay, you have high fees, high headline fees, sometimes called TER, total expense ratio, sometimes called OCF, which is ongoing charges figure. They largely mean the same thing. These are the headline fees that they have to disclose, right? In addition to the high headline fees, which are ongoing annual management fees, there are also initial fees with some funds. Okay, so be careful of those. There are sometimes exit fees. Be careful of those. Okay, and sometimes these fund managers are trading in and out of individual names. You remember earlier that there was the fund consisted of 40, 50, 60, if not more, names, companies, shares that they are holding. And sometimes they trade them around with high frequency. That incurs costs. And that is not shown in the headline rates. That's an additional cost which is borne by the fund. Okay, so it's almost like a hidden fee. There are all sorts of other layers of fees. So there's research fees that sometimes when I was doing this day in, day out, I would buy in research from other companies, right? Guess who pays for that? The ultimate investor. I often got taken out to the FA Cup final, to Wimbledon, things like that. So, and guess who pays for all of that stuff? And then there are trips. So I used to cover the Japanese market. So I would frequently go out to Japan and Asia to do my research, to visit companies. And of course, they wouldn't fly me on economy. So there are all sorts of costs that are borne by the fund. And ultimately, who's paying for that? Is the investor who buys into active funds. Okay, so be careful about all of these fees. There are lots of, the fees themselves are very high, but there are lots of layers of hidden fees also. Now, all of that wouldn't really matter that much if the returns were good and the returns were there to show for all of this, okay? You wouldn't mind paying higher fees. You wouldn't even mind the marketing, okay? You don't mind the expensive fund managers and the swanky offices. If you're getting good returns, the rest doesn't really matter. So is that the case? Sadly not. So there is lots of evidence out there. I'm going to show you two pieces of evidence. So one is, it's on the internet, it's called Spot the Dog. It's an annual publication by a platform called Best Invest. So you can just Google that and it's called Spot the Dog. They refresh it every year. And you can see on there the top 10 underperforming funds by a huge margin. All the household names will be on there, Bailey Gifford, etc. And it changes from time to time, but all the big household names which are advertising heavily, which are very clever marketing, which had done well previously, are not doing so well. Okay, so have a look at that. But an even better survey, piece of evidence, is something called the SPIVA index, SPIVA. The SPIVA index collects information from a wider range of funds across the world, across different time periods. Okay, so just one very quick example in the US, and it's the same replicated across the world in Europe, in the UK, in Asia. In the US, 88% of fund managers underperform the index. Okay, so these are active funds underperforming passive funds. Again, it begs the question, why on earth would somebody invest in active funds and pay a higher fee for the privilege? So all the evidence is pretty overwhelming. Okay, there is no question that active funds consistently and significantly underperform the index. And just to give you a few high-profile names that you will be familiar with. So Fundsmith is, I actually respect Fundsmith. Terry Smith is the fund manager. He's had a very good long-term performance, just to highlight that nobody's immune. Just because somebody has a good reputation, just because they go through a period of outperformance, it doesn't make them immune from having a long period of underperformance. So Fundsmith has been underperforming a comparable passive index for 3 years, if not longer. And that underperformance amounts to 15, 20%. Okay, so that's one, is Fundsmith. Another one, very high profile name, Scottish Mortgage. Now, if you're not familiar with Scottish Mortgage, it's an investment trust. It's another variation of an active fund, and nothing to do with Scotland, nothing to do with mortgages. It's actually a sort of type of disruptive technology fund. They like high growth disruptive technology names. Okay. And this was a market darling. Everybody loved Scottish Mortgage around the sort of COVID period, just post COVID. And it did incredibly well during that time. When there was a big rush to online, they captured that really well. Unfortunately, since then, it's been a huge underperformer. Okay. And again, over the last 2-3 years, it's been a massive underperformer just at the time when it attracted so many assets. And that underperformance has continued, has persisted. And in a lot of the last 2 or 3 years, that underperformance has widened. So again, be careful of these high profile names, which have a good reputation, with which the IFAs and the magazines will be talking about at the time. It's our job to be aware that our performance cannot ever continue for most of these active fund managers. And finally, the biggest disaster of them all. This is the poster child of active fund manager failures, and it's the Woodford fund. Now, some of you might be familiar, might remember the high-profile fund manager called Neil Woodford. Now, Neil Woodford did really well for a period of time at Invesco, his previous employer. So he did really well, and he decided to capitalize on that and set up his own. And he got the support of every single platform, IFA, wealth management firm. Seemingly all the newspapers, the magazines were just salivating about Neil Woodford. And the fund did amazingly well at capturing interest, capturing our pounds and dollars. And sadly, it just was a complete and utter disaster. So much so that there's a lot of people who've lost almost all of their money now. Okay, the fund has collapsed. It's gone into administration, and this is such a poster child because it was so heavily marketed by all sorts of IFAs who should have known better, all sorts of investment platforms, all sorts of kind of fund management, investment specialist publications and magazines, etc., etc. It was so heavily promoted and marketed, and it just became a complete and utter disaster. They were investing in things that had nothing to do with their mandate, etc., etc. It's a complete basket case. So again, another example of why to be careful of heavily promoted active funds, which also happen to have high fees. Please don't be influenced by brand names. Don't get sucked in by the marketing. Low cost is often better performance. In fact, investing is the only industry where you don't get what you pay for. Okay, it's the only industry where the lower your fees, the lower the price, the better is your outcome. That's the only industry I know that is true. So stay passive, avoid active to best compound for your financial future. And if you want to see more on how to invest properly, check out our Investment Academy on the website. And for more information, watch my video here.